Most traders use moving averages the wrong way, and it costs them. If you're relying on crossovers and chasing trends blindly, you're already behind. In this video, you'll learn how to use moving averages the smart money way, with precision, structure, and multi-time frame confirmation, so you stop guessing and start entering with confidence. Before we dive in, here's what you'll learn in this video. How to spot real trends using moving averages. The smart way to catch reversals before they happen. How to use moving averages as dynamic support and resistance. How to combine price action and structure for high-precision entries. A complete trend-following strategy that smart money uses. A powerful reversal setup backed by structure and confluence. These strategies work on all time frames and apply to all markets. Forex, stocks, crypto, futures, and even options. If you're serious about trading smarter, not harder, subscribe now and turn on the bell so you never miss a strategy that gives you an edge. Let's get started. Moving averages are powerful tools, but only if you know how to use them correctly. They serve three main purposes: identifying the market trend, spotting trend reversals, highlighting dynamic areas of support and resistance. Let's break each one down, starting with how to identify the trend. The moving average is primarily a trend-following indicator. It helps smooth out price data so you can better understand the overall direction of the market. One quick method to determine the trend is by comparing price to the moving average itself. If the price is above the moving average and remains there, we're likely in an uptrend. That's where you look for buying opportunities. If the price is below the moving average and continues to stay under it, we're probably in a downtrend. In this case, it makes more sense to focus on short setups. But in sideways markets, price tends to bounce above and below the moving average without consistency, like a pendulum. These conditions offer little clarity and are best avoided until a clear direction forms. To improve your analysis, consider using two moving averages with different timeframes, one short-term and one long-term. This gives you a broader perspective. We use a 20-period moving average, that's the white line, to track short-term trends, and a 200-period moving average, shown in yellow, to capture the overall long-term direction of the market. Now let's interpret the chart. When price is above the 20-period moving average, the short-term trend is bullish. When price is below the 20-period moving average, the short-term trend is bearish. But that's not the full story. If we now bring the 200-period moving average back into view and see that price has consistently stayed above it, that suggests the long-term trend is still bullish. So even if price dips below the 20-period moving average briefly, those short-term sell signals may not be worth taking. You'd be going against the long-term trend, which is risky. Let's look at another part of the chart. Here, price is hovering around the 20-period moving average, moving sideways with no clear momentum. That's a short-term range, but since price is still holding above the 200-period moving average, the long-term bias remains bullish. In this situation, you have two choices: stay out of the market and wait